studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
In this section, we move away from individual compensation planning decisions and begin looking at a broader issue: how government policy can influence tax planning strategies. The focus of this slide is the government's review of private corporation tax planning and the consultation process that followed. The most important lesson is simple: tax planning strategies do not exist in isolation. They operate within a system of tax laws, and those laws can change. That is why professional advisors must understand not only how planning strategies work today, but also how government policy may affect them tomorrow. At the center of the slide, we see a government building surrounded by files relating to private corporations, tax planning, corporate structures, and tax policy. This visual represents the government's review process. As private corporation planning strategies became more widely used, governments began examining whether certain tax outcomes were consistent with their policy objectives. The review was not focused on whether private corporations should exist, nor was it focused on whether business owners should engage in legitimate tax planning. Instead, the discussion centered on how certain planning strategies interacted with the tax system. On the left side of the slide, we see several common planning strategies that private corporations have historically used. One example is income splitting. This involves distributing income among family members under certain circumstances. Another example is passive investing within a corporation. Business owners may retain earnings inside the company and invest those funds for future growth or retirement purposes. We also see tax deferral opportunities. In some cases, retaining profits within a corporation allows taxes to be deferred until funds are withdrawn personally. And finally, family planning strategies often use corporate structures to support broader family financial objectives. These approaches have long been part of private corporation planning. However, as they became more widely discussed, questions began to emerge regarding how these strategies affected the overall tax system. That brings us to the right side of the slide. Here we see the government's perspective. Policymakers and tax officials began reviewing certain outcomes associated with private corporation planning. One concern involved perceived tax fairness. Some argued that individuals operating through corporations could achieve tax outcomes that were not available to individuals earning employment income. Another area of discussion involved income splitting. Questions were raised about when income splitting should or should not be permitted. Passive investment accumulation also became a topic of debate. Policymakers examined whether large investment portfolios held inside corporations created tax advantages that should be reconsidered. Tax deferral benefits were also reviewed, and broader questions were asked about consistency within the tax system. Whether one agrees or disagrees with these concerns is not the point of this slide. The purpose is to understand why the consultation occurred. Governments regularly review tax rules to determine whether they continue to reflect current policy objectives. At the center of the slide, we see the consultation process itself. Private corporation planning leads to government review. Government review leads to consultation. Consultation leads to discussion and feedback. And that process can eventually lead to rule changes. This is an important cycle for advisors to understand, because tax rules are not static. They evolve over time. At the bottom of the slide, we see a timeline that summarizes the process. Existing rules are reviewed. Government consultations are conducted. Public feedback is gathered from advisors, businesses, and stakeholders. And eventually, tax changes may occur. This timeline illustrates how policy evolves. The quote at the top captures the lesson perfectly. Tax rules can change when governments review planning strategies. That statement is extremely important for advisors. A strategy that works well today may be affected by future legislative changes. That does not mean planning should stop. It simply means planning should remain flexible and informed. The key takeaway from this slide is simple. Governments regularly review tax policy. Private corporation planning strategies can become part of those reviews. And effective advisors must stay informed about legislative developments so they can adapt strategies when rules change. Because successful planning is not just about understanding today's rules. It is also about preparing for tomorrow's possibilities. To understand the private corporation tax consultation, it is important to understand that the discussion was not simply about taxes. At its core, it was a debate between two different perspectives. On one side were business owners and advisors who viewed private corporations as important tools for managing risk, building wealth, and planning for the future. On the other side were policymakers who focused on fairness, consistency, and protecting the integrity of the tax system. This slide illustrates both sides of that discussion. Let's begin with the business owner perspective on the left side of the slide. Business owners often argue that operating a business involves significant risk. Unlike employees, they may not have guaranteed income. They may not have employer-sponsored pension plans, and they may face years of uncertainty before achieving financial success. Because of these risks, many business owners believe they should have access to planning opportunities that help them build financial security. One common argument is the need to save for risk. Businesses face economic downturns, changing markets, and unexpected expenses. Retaining capital within a corporation can provide a financial buffer during difficult periods. Another argument involves income uncertainty. Business income is often inconsistent. Some years may be highly profitable. Others may be much more challenging. Corporate planning tools can help smooth those fluctuations over time. Retirement planning is another important consideration. Many entrepreneurs do not have traditional workplace pension plans. As a result, retained corporate earnings often become an important part of their retirement strategy. Business owners also argue that accumulated corporate capital supports growth. Those retained funds can be used to invest in equipment, hire employees, expand operations, or pursue new opportunities. Finally, many believe that entrepreneurial risk should be rewarded. Building a business requires effort, investment, and personal risk, and some argue that the tax system should recognize those realities. Now let's move to the government perspective on the right side of the slide. Policymakers often approach the issue from a different angle. Their primary concern is maintaining a fair and sustainable tax system. One major consideration is tax fairness. Governments seek to ensure that taxpayers in similar economic situations are treated fairly under the tax rules. Another concern is preventing abuse. Policymakers want to avoid situations where tax rules produce results that were never intended. They also focus on limiting unintended advantages. When certain planning techniques create outcomes that appear inconsistent with broader policy objectives, governments may review those rules. Protecting the tax base is another key priority. Governments rely on tax revenue to fund public services and programs. As a result, they monitor how tax rules affect long-term revenue collection. Finally, policymakers strive for consistency. A tax system that is perceived as fair and consistent is generally easier to administer and maintain over time. At the center of the slide, we see a balance scale. One side represents supporting business growth. The other represents protecting tax fairness and integrity. This is the heart of the debate. The challenge is finding the appropriate balance between encouraging entrepreneurship and maintaining confidence in the tax system. Notice the statement beneath the scale. both sides have valid concerns. This is a very important point. The purpose of understanding this debate is not to declare one side right and the other side wrong. Rather, it is to understand that tax policy often involves balancing competing objectives. Governments want economic growth. Businesses want planning flexibility. And both goals must coexist within the same tax system. The quote at the bottom summarizes the lesson perfectly. Good advisors understand both the planning opportunities and the policy environment. This is what separates technical knowledge from professional judgment. Advisors must understand how planning strategies work, but they must also understand why governments may choose to review or modify those strategies. The final takeaway from this slide is simple. Tax planning does not exist in a vacuum. It exists within a policy framework that is constantly evolving. The best advisors understand both sides of the conversation, because understanding the policy environment helps them build strategies that remain effective, practical, and sustainable over the long term. This final slide focuses on the most important question in this entire section. What should advisors learn from the private corporation tax consultation? The answer is straightforward. Tax rules change, planning strategies evolve, and successful advisors adapt. That is the central lesson of this slide. The purpose of studying government consultations and legislative changes is not simply to understand history. The purpose is to become a better advisor, an advisor who understands how policy changes affect planning strategies, an advisor who can recognize new opportunities and new risks, and an advisor who can help clients navigate change with confidence. At the center of the slide, we see the advisor adaptation workflow. This process begins with legislative change. Governments introduce new rules, modify existing rules, or clarify how certain provisions will operate. Whenever that happens, advisors must pay attention. The next step is advisor analysis. This is where the advisor studies the new legislation and evaluates its impact. How does the change affect existing planning strategies? Which assumptions are no longer valid? What opportunities remain available? And what new risks have emerged? Once the analysis is complete, the advisor moves to client review. Because tax changes are not just technical events. They affect real people. The advisor must determine whether existing plans continue to support the client's objectives under the new rules. Next comes updating the strategy. Recommendations may need to be adjusted. Planning structures may need to be modified. And in some cases, entirely new approaches may need to be considered. The final step is ongoing monitoring. Tax systems continue to evolve, and effective advisors continuously monitor legislative developments rather than assuming the rules will remain unchanged. At the center of the slide, we see an advisor reviewing tax law updates on a computer screen. The screen displays new rules, tax bulletins, planning scenarios, and client reports. This visual highlights a key reality of professional practice. Learning does not stop once a strategy is implemented. Professional advisors continually educate themselves and update their knowledge, because staying informed is one of the most important responsibilities in tax planning. On the left side of the slide, we see the broader consultation process: government review, policy discussions, legislative changes, and ongoing evolution. This reminds us that tax systems are dynamic. Rules are reviewed, policies are debated, changes are introduced, and planning strategies must evolve accordingly. On the right side of the slide, we see several important questions every advisor should ask when legislative changes occur. Have tax rules changed? Will the current strategy still work? Are our assumptions still valid? Do clients need updates or adjustments? And are there new opportunities available? These questions help advisors move from reacting to change toward proactively managing it. The best advisors do not wait until problems appear. They evaluate changes early and adjust plans before issues arise. At the bottom of the slide, we compare two different approaches. The first approach ignores legislative change. This often leads to outdated advice, increased risk, and missed opportunities. A strategy that was effective years ago may no longer be appropriate under current rules, and clients can be exposed to unnecessary risks when advisors fail to adapt. The second approach embraces legislative change. This leads to better advice, better planning, and better long-term outcomes. Strategies remain relevant, compliance risks are reduced, and clients benefit from recommendations that reflect the current tax environment. The statement at the bottom summarizes the entire lesson perfectly. The best advisors adapt when the rules change. This is one of the defining characteristics of professional excellence. Technical knowledge is important, but adaptability is equally important. Because tax planning is not static. The environment changes, the rules change, and successful advisors change with them. The key takeaway from this slide is simple. Stay informed. Monitor legislative developments. Review planning assumptions regularly. And be willing to update strategies when circumstances change. Because the most effective advisors are not those who rely on yesterday's rules. They are the advisors who continuously learn, adapt, and help clients succeed in an ever-changing tax environment.